LiteFinance.
Hello, it's Monday, October 30th, and of course it is time to start the market forecast, where today we will focus on the analysis of CHF. But we must start with the calendar as always. Okay, so today we will get a preliminary GDP from Germany. On Tuesday we will get manufacturing PMIs from China, a Bank of Japan rate decision, Eurozone CPI inflation and GDP, Canadian GDP and US CB consumer confidence. On Wednesday, ADP employment, US ISM PMI, and most importantly, FOMC rate decision. Next on Thursday, Bank of England rate decision, and on Friday, non-farm payrolls along with the US services PMIs. So as you can see, the calendar is packed with the high importance events and data publications. But now we move on and we'll discuss what is happening with the Swiss franc and try to make a trading plan for the USD CHF currency pair. So the franc is a rare rock the USD is crushing against. The USD is rallying on growing bond yields, falling stock indexes, and worsening financial conditions were supposed to bury all the rivals. However, the Swissy stood up and can now become the best G10 performer for the first time since 2015. In January to July, the USD CHF quotes declined on SNB's currency interventions and expectations of the Fed's dovish turn. In October, they continued falling as geopolitics and European economics weakness came on stage. The SNB has spent around 100 billion francs since the beginning of 2022 to support the franc's rate using revaluation to cut imported inflation. The central bank no longer has to intervene with the forex at present. Consumer prices in Switzerland slowed down from 3.3 to 3.4% at the beginning of the year to 1.6 to 1.7% in June-September. The bank kept the key rate at the previous level of 1.75% at the latest meeting, saying the reason for inflation growth has roots in domestic factors only. In October, the Swissy strengthened against amid the Middle East crisis. Investors brought it more often than the USD, recalling its safe haven status. Nevertheless, the USD CHF bears will lose the geopolitics trump if the conflict is settled through diplomacy. Meanwhile, the rise of the trade-weighted value of the franc to its highest poses a problem to Swiss exporters, putting pressure on the SNB. Let's also note the growth of real bond rates, which is good for carry trade and the Swissy as a funding currency. So investors have at least 4 reasons to buy the USD CHF. The national bank's refusal to carry out currency interventions, concern over exporters, the escalation of geopolitical conflicts, and growing demand for carry trade. Still, as it's not that easy, the SNB is only worried about inflation signs, not about exporters. Reuters experts estimate that consumer prices will grow only by 1.5% in 2024, remaining in the target range of 0 to 2%. Risk appetite must grow for carry trade to develop, but the fall of US stock indexes suggests that's not the case. Conversely, an economic slowdown in the US to 0.7% in Q3 and concerns over the US government shutdown will be a favorable wind for USD CHF bears. Also, we may still have to deal with an increased chance of an economic downturn in the Eurozone and Great Britain in the second half of the year, and a differential between Italian and German bond yields growing to over 200 basis points, an indicator of political risks. So it's too early to bury the franc. On the contrary, the USD CHF's failure to consolidate above 0.8985 will prompt us to sell the pair. And so that will be all for today. Thank you guys for watching, and I'll see you next week.